What if I told you that gold is about to do something it hasn't done in over 4 decades? Not a rally, not a breakout, a vertical launch into price territory that will rewrite every textbook on precious metals investing. Right now, as you're watching this, gold is sitting in the most explosive technical setup I've seen in my entire career. And here's what makes this absolutely terrifying for anyone not positioned. There's literally nothing above us. No resistance, no ceiling, just open air. Let me show you exactly what's happening, because this isn't speculation. This is mathematical inevitability playing out in real time across every major market on the planet. The chart tells a story that should make your blood run cold if you're holding cash. Gold just completed a multi-year inverted head and shoulders pattern. For those unfamiliar, this is one of the most reliable bullish formations in technical analysis. It's like watching a coiled spring compress for years, and we just hit the release point. But here's where it gets interesting. When gold broke above the neckline resistance earlier this year, it didn't just break. It exploded through with the kind of volume that signals institutional accumulation on a scale we haven't seen since the 1970s, and that comparison isn't random. In 1971, when Nixon closed the gold window and ended dollar convertibility, gold was trading at $35 an ounce. Over the next 9 years, it went to $850. That's a 2,400% gain. But here's what most people miss about that move. It wasn't linear. It was a series of consolidations followed by vertical launches that left everyone scrambling. The first major move took gold from $35 to $200 between 1971 and 1974. Then it consolidated for 4 years. People thought it was over. The experts said gold had peaked. And then, in 1978, something changed. The second wave began, and gold went from 200 to 850 in just 2 years. The final 18 months of that move saw gold triple. Why am I telling you this? Because we're watching the exact same pattern unfold right now, except the numbers are bigger, much bigger. Gold started this current bull market around $1,060 back in late 2015. It's now trading well above $3,000. That's already a nearly 300% gain. But if you overlay the 1970s pattern onto today's chart, accounting for monetary expansion and the size of global markets, we're not even close to the vertical phase yet. The consolidation we saw through 2021 and 2022, that was our 4-year pause. The breakout in 2023 and 2024, that's the beginning of the second wave. And if history rhymes, we're about to enter the phase where gold doesn't just rise, it launches. Now let me show you why this time is actually different, and not in the way that phrase usually means. This time, the fundamentals supporting gold are exponentially stronger than they were in the 1970s. Start with central bank buying. In the 1970s, central banks were actually selling gold. They thought it was a barbarous relic. They were wrong, but that's what they believed. Today, central banks are buying gold at the fastest pace in recorded history. We're talking about over 1,000 tons per year for the last 2 years straight. China's central bank has been buying every single month. Poland just announced they're doubling their gold reserves. India is accumulating. Even countries you wouldn't expect, like Singapore and the Philippines, are loading up. This isn't random. This is coordinated de-dollarization happening in real time. And here's the kicker. These aren't small purchases. When China buys gold, they're not buying paper contracts on the COMEX. They're taking physical delivery of actual metal. That matters because it removes supply from the market permanently. Once that gold goes into a central bank vault, it's not coming back out. But central banks are just one piece of this puzzle. Let's talk about what's happening in the physical market, because this is where things get truly explosive. The COMEX, which is the primary exchange for gold futures in the United States, has a problem. A big problem. The ratio of paper gold to physical gold has been climbing for years. Right now, for every ounce of physical gold in COMEX vaults, there are roughly 100 ounces of paper claims against it. Think about that. If even 10% of the people holding paper gold decided they wanted physical delivery, the entire system would collapse. And guess what's been happening? Delivery requests have been surging. Not from retail investors, but from major institutions and foreign entities who are starting to question whether that paper is actually backed by anything real. This is creating what's called a squeeze. And not just any squeeze, a structural squeeze that cannot be resolved without significantly higher prices. Here's why. Gold mining production has been flat to declining for years. The easy gold has been found. New discoveries are rare, and even when they find a deposit, it takes 10 to 15 years to bring a new mine into production. Meanwhile, demand is exploding. Industrial demand for gold in electronics and technology is at all-time highs. Jewelry demand in Asia remains insatiable. Investment demand is surging as people wake up to the reality of currency debasement. And now you add central bank buying on top of all that? The math doesn't work. There isn't enough physical gold to satisfy demand at current prices. Something has to give, and that something is price. Now, I want to talk about something that most analysts are completely missing: the role of the dollar in all of this. Because what's happening to the dollar right now is setting up gold for a move that will shock even the most bullish gold bugs. The dollar has been the world's reserve currency since World War II. That status has given the United States an extraordinary privilege, the ability to print money and export inflation to the rest of the world. But that privilege is ending. Not might end, is ending. Right now. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with dozens of other countries that have joined or are joining, are actively building an alternative financial system. They're settling trade in their own currencies. They're creating new payment systems that bypass the dollar, and they're backing it all with gold. Saudi Arabia just announced they're open to settling oil sales in currencies other than dollars. That's seismic. The petrodollar system has been the foundation of dollar dominance for 50 years. If that unravels, and it is unraveling, the implications for gold are almost incomprehensible. Here's a thought experiment. What happens when countries that have been forced to hold dollars for trade suddenly don't need to hold dollars anymore? They sell those dollars and buy real assets. And the ultimate real asset, the one that's been money for 5,000 years, is gold. We're already seeing this play out. Foreign central banks have been net sellers of U.S. treasuries for years now. Where's that money going? Some of it's going into their own bonds, some into infrastructure, but a huge chunk is going into gold. Because gold can't be sanctioned, gold can't be frozen, gold can't be printed into oblivion by a central bank trying to finance unlimited government spending. Speaking of government spending, let's talk about debt. Because the debt situation in the United States and across the developed world is the elephant in the room that nobody wants to acknowledge. The U.S. national debt just crossed $36 trillion. The interest payments on that debt are now over $1 trillion per year. That's more than the defense budget. And it's accelerating. Every time interest rates tick up, the government has to pay more to service existing debt. Every time they run a deficit, which is every single year, they add more debt that requires more interest payments. This is what's called a debt spiral. And there are only 3 ways out: grow your way out, cut spending dramatically, or inflate your way out. Growing out of it would require sustained GDP growth well above the interest rate on the debt. That's not happening. Cutting spending would require political will that doesn't exist. So that leaves option 3, inflation. And that's exactly what they're going to do. They have no choice. The Federal Reserve will keep rates lower than they should be. The government will keep spending. And the currency will keep losing purchasing power. It's not a conspiracy. It's just math. Now, if you're sitting on retirement savings, this should concern you deeply, because everything I just described means your dollars are going to buy less and less over time. The question isn't whether inflation is coming. The question is how you protect yourself from it. Quick aside here, because this is important. If you have $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs actually work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. No pressure, just information. Anyway, back to why gold is about to go vertical. Let's talk about the technical setup, because this is where things get really interesting. Gold just broke out of a massive consolidation pattern that lasted nearly 2 years. From late 2020 through mid-2022, gold was stuck in a range between roughly $1,700 and $2,000. It tested that $2,000 level multiple times and got rejected every single time. Then, in early 2023, something changed. Gold broke above $2,000 and never looked back. It consolidated briefly around $2,100, then pushed to $2,300. Another consolidation, then a surge to $2,600. Each consolidation was shorter than the last. Each surge was stronger. This is classic bull market behavior: higher highs, higher lows, and accelerating momentum. But here's what makes the current setup so explosive. Gold just broke above the upper boundary of a rising channel that's been in place since the 2023 breakout. When price breaks out of a rising channel to the upside, it typically signals the beginning of a parabolic move. And there's nothing above us. No previous resistance levels. No psychological barriers that held in the past. We're in price discovery mode. And in price discovery, momentum tends to accelerate because there are no sellers who bought at higher prices looking to get out. Everyone who owns gold right now is sitting on profits. That creates a very different market dynamic. Now, let me show you what the smart money is doing, because this is where you can see the future before it happens. The Commitment of Traders report, which tracks positioning in futures markets, shows something fascinating. Commercial traders, which are typically the big banks and institutions that hedge physical gold positions, have been reducing their short positions dramatically. These are the players who usually bet against gold rallies. The fact that they're covering shorts tells you they see something coming. At the same time, large speculators, which include hedge funds and professional traders, have been building long positions. But here's the key. Their positioning isn't anywhere near the extremes we saw at previous tops. In 2011, when gold hit $1,900, speculative positioning was at record highs. Everyone was bullish. That's usually when rallies end. Right now, positioning is elevated but nowhere near extreme. That means there's still a massive amount of buying power on the sidelines. When those players start piling in, and they will, that's when we get the vertical move. Let me give you a specific example of how fast things can move when gold goes parabolic. In August 2020, gold was trading around $1,800. Within 3 weeks, it hit $2,100. That's a $300 move in less than a month. And that wasn't even a true parabolic move. That was just a momentum surge in an already strong bull market. Now imagine what happens when we get a real parabolic move, when fear kicks in, when people realize their currency is losing value faster than they thought, when the headlines start screaming about inflation and debt and currency crisis. That's when gold doesn't move $300 in 3 weeks. It moves $300 in 3 days. And here's why I'm so confident this is coming. Every single indicator that preceded previous gold bull markets is flashing right now. Every single one. Real interest rates, which are nominal rates minus inflation, are deeply negative. That's rocket fuel for gold. When you can't earn a positive real return in bonds or savings accounts, gold becomes the obvious alternative. Currency debasement is accelerating globally. It's not just the dollar. The euro, the yen, the pound, they're all being printed into oblivion. Every major central bank is trapped in the same debt spiral, and when all currencies are losing value simultaneously, gold is the only universal store of value. Geopolitical tensions are at levels we haven't seen since the Cold War. Wars in multiple regions, trade conflicts, sanctions flying back and forth. Every time geopolitical risk rises, gold benefits, and right now, geopolitical risk is off the charts. The banking system is showing cracks. We saw bank failures last year. We're seeing stress in commercial real estate. We're seeing deposit flight from smaller banks to larger ones. Every time confidence in the banking system wavers, gold rallies. Because gold is the ultimate safe haven. It's not someone else's liability. It's not dependent on a bank staying solvent. It just is. Let me tell you a story that illustrates why this matters. In 2008, during the financial crisis, there was a brief moment when gold actually sold off. People were confused. Shouldn't gold rally during a crisis? But here's what was happening. Hedge funds and institutions were getting margin calls. They needed cash immediately, so they sold whatever they could sell, including gold. But that sell-off lasted about 3 months. From March 2008 to October 2008, gold dropped from about $1,000 to $750. Then, as the full scope of the crisis became clear, as governments started printing money to bail out banks, as people realized the system was more fragile than they thought, gold took off. It went from $750 in October 2008 to $1,900 by September 2011. That's a 150% gain in less than 3 years. And here's the thing. The problems that caused the 2008 crisis never got solved. They got papered over with printed money. The debt didn't go away. It got bigger. The systemic risks didn't disappear. They got worse. We're living in a world with more debt, more leverage, more risk, and more currency creation than at any point in human history. Gold knows this. The smart money knows this. And increasingly, regular people are figuring it out too. I want to talk about something that doesn't get enough attention, the supply side of the gold market. Because while everyone focuses on demand, Supply is where the real story is. Global gold production peaked around 2018 at roughly 3,300 tons per year. Since then, it's been flat to slightly declining. The major gold mining companies are struggling to replace reserves. The ore grades at existing mines are declining, meaning they have to process more rock to get the same amount of gold. And new discoveries are increasingly rare and increasingly expensive to develop. Meanwhile, the cost of production has been rising. Energy costs, labor costs, equipment costs, regulatory costs, all going up. The all-in sustaining cost for many gold miners is now above $1,000 per ounce. Some are even higher. That puts a floor under the gold price. Because if gold drops below production costs, mines shut down, supply drops further, and price has to rise. But here's where it gets interesting. Even at current prices above $3,000, mining companies aren't rushing to develop new projects. Why? Because they've been burned before. They remember what happened in 2011 when gold hit 1,900 and then crashed back to 1,100. They built new mines, expanded production, and then got crushed when prices fell. So they're being cautious. They're returning cash to shareholders instead of investing in new production, which means even as gold prices rise, supply isn't responding. That's the setup for a true supply squeeze. And it's not just mining supply. Recycling supply, which comes from people selling old jewelry and scrap gold, has been declining too. Why? Because people are holding on to their gold. They're not selling at these prices because they think it's going higher. And they're right. Let me paint you a picture of what happens when this supply-demand imbalance really kicks in. Imagine you're a central bank that needs to buy 100 tons of gold. You go to the market and start buying. But there's only 50 tons available at current prices. What happens? Price rises until someone is willing to sell. Maybe that's at $3,500. Maybe it's at $4,000. Maybe it's at $5,000. Now multiply that by dozens of central banks all trying to buy at the same time. Multiply it by millions of individual investors waking up to the reality of currency debasement. Multiply it by institutional investors who need to hedge their portfolios against inflation and geopolitical risk. The amount of money that could flow into gold is staggering. The entire gold market, all the gold ever mined in human history, is worth maybe $15 trillion at current prices. That sounds like a lot until you realize there's over $300 trillion in global financial assets. If just 1% of that shifts into gold, that's $3 trillion of buying pressure hitting a $15 trillion market. What do you think happens to price? It doesn't go up 10%, it doesn't go up 50%, it goes vertical. Now, I want to address something that skeptics always bring up. What about Bitcoin? Isn't Bitcoin the new gold? Doesn't digital gold replace physical gold? Here's my take. Bitcoin and gold serve different purposes. Bitcoin is an incredible technology. It's a decentralized digital asset that can't be controlled by any government. It has a fixed supply. It's portable and divisible. All of that is true. But Bitcoin is also volatile. It's still relatively new. It requires technology and electricity to access. And it's not recognized by central banks as a reserve asset. Gold is all of those things Bitcoin isn't. It's stable. It's been money for 5,000 years. It doesn't require technology, and central banks hold it as their ultimate reserve. The reality is, both can go up. In fact, they probably will both go up, because the underlying driver is the same: loss of confidence in fiat currencies. When people lose faith in paper money, they move to hard assets. Some choose Bitcoin, some choose gold, many choose both. But if I had to bet on which one central banks and major institutions will pile into during a currency crisis, it's gold, every single time. Because gold is the asset they understand. It's the asset they've held for centuries. It's the asset that's saved them in every previous crisis. Let me give you another historical parallel, because history doesn't repeat, but it sure does rhyme. In 1980, gold hit $850. Adjusted for inflation, that's about $3,000 in today's money. We're already there. But here's what most people don't realize. Gold in 1980 represented about 25% of the value of the Dow Jones Industrial Average. Today, gold represents about 10% of the Dow's value. If gold were to reach the same ratio it hit in 1980, we're talking about gold at $8,000 to $10,000 per ounce. And that's not some wild prediction. That's just gold returning to a valuation level it's already achieved in the past. But wait, there's more. In 1980, the U.S. debt to GDP ratio was about 30%. Today, it's over 120%. The money supply was a fraction of what it is today. The global financial system was much smaller, If you adjust for all of those factors, the equivalent of 1980's gold price in today's environment isn't $3,000. It's not even $8,000. It's somewhere north of $15,000 per ounce. Now, I'm not saying gold is definitely going to $15,000. I'm saying the fundamental case for gold at $15,000 is actually stronger today than the case for gold at $850 was in 1980. And gold hit $850 in 1980. Let's talk about what happens in the next phase of this bull market, because understanding the psychology of a parabolic move is crucial if you want to navigate it successfully. Right now, we're in what I call the awareness phase. Some people own gold, some people are paying attention, but the mainstream isn't there yet. Your average person on the street isn't talking about gold. Financial advisors aren't recommending it. The talking heads on TV are still debating whether gold is relevant. That's about to change. As gold breaks through 3,500, then 4,000, then 5,000, the headlines will start. Gold hits all-time high. Gold surges on inflation fears. Is gold the new safe haven? The mainstream media will start covering it, and that's when the real buying begins. Because here's how human psychology works. People don't buy when assets are cheap and nobody's talking about them. They buy when assets are expensive and everyone's talking about them. It's called FOMO, fear of missing out. And it's one of the most powerful forces in financial markets. When gold starts making headlines, when your neighbor mentions they bought some gold, when financial advisors start recommending gold exposure, that's when we enter the mania phase. And in the mania phase, price doesn't follow fundamentals anymore. It follows emotion, fear, greed, panic, euphoria, all of it compressed into a buying frenzy that pushes prices to levels that seem absurd in hindsight but feel inevitable in the moment. I saw this in 2011. I watched gold go from 1,500 to 1,900 in a matter of months. People were buying at any price because they were convinced it was going to 3,000, 5,000, 10,000. And you know what? They might have been right about the ultimate destination. They were just early. The market wasn't ready yet. But now the market is ready. The fundamentals are in place. The technical setup is perfect. The catalysts are everywhere. All we need is the spark. And that spark could be anything. A banking crisis, a geopolitical event, an inflation report that shocks everyone, a central bank announcement. It doesn't matter what the specific trigger is. The powder keg is loaded. It just needs a match. Here's what I'm watching for in the coming weeks and months. First, I'm watching the dollar. If the dollar starts breaking down, if it loses key support levels, that's your signal that gold is about to explode. Because gold and the dollar are inversely correlated. When the dollar falls, gold rises. And right now, the dollar is looking vulnerable. Second, I'm watching real interest rates. If inflation stays elevated while the Fed keeps rates lower than they should be, real rates stay negative. And negative real rates are gold's best friend. Every time real rates go negative, gold rallies. Every single time. Third, I'm watching central bank buying. If we see an acceleration in central bank purchases, if we see more countries announcing they're increasing gold reserves, that's confirmation that the smart money is positioning for what's coming. And fourth, I'm watching the physical market. If we start seeing delivery problems on the COMEX, if we see premiums for physical gold over paper gold start widening, that's your signal that the squeeze is on. That's when things get really interesting. Now, let me be clear about something. I'm not saying gold goes straight up from here. Markets don't work that way. There will be pullbacks. There will be consolidations. There will be moments where it feels like the rally is over. That's normal. That's healthy. Those pullbacks are opportunities for people who missed the initial move to get positioned. But the overall trajectory is clear. Gold is going significantly higher. Not because I say so. Not because some guru predicted it. But because the fundamental forces driving gold are stronger than they've been in decades. And when fundamental forces align with technical setups and market psychology, you get moves that rewrite the history books. Think about what's at stake here. We're talking about the potential end of the dollar's reserve currency status. We're talking about a global monetary reset. We're talking about the greatest wealth transfer in human history as value moves from paper assets to hard assets. And gold is the ultimate hard asset. The people who understand this, who position themselves ahead of the crowd, are going to do extraordinarily well. The people who wait, who dismiss gold as a barbarous relic, who trust that governments and central banks have everything under control, are going to watch their purchasing power evaporate. I'm not trying to scare you. I'm trying to wake you up. Because the signs are everywhere. The debt is unsustainable. The currency creation is out of control. The geopolitical situation is deteriorating. The financial system is more fragile than it appears. And gold is the canary in the coal mine, telling us that something big is coming. So here's my challenge to you. Look at the evidence. Look at what central banks are doing. Look at what the smart money is doing. Look at the technical charts. Look at the fundamentals. And then ask yourself, does it make sense to have zero exposure to gold right now? Because if you wait until gold is at $5,000 or $8,000 or $10,000, you'll still make money if it goes higher. But you'll have missed the most explosive part of the move. You'll have missed the opportunity to position yourself before the crowd figured it out. The setup is perfect. The resistance is gone. The fundamentals are screaming. And the technical pattern is textbook. Gold is setting up for a vertical launch. The only question is whether you'll be positioned when it happens.